Kerry Craig is a global investment strategist at JP Morgan. In many respects, a perfect person to talk to given how volatile the markets are. We covered quite a bit of ground in this conversation, including why it's so important to be clear on your investment goals given the erratic nature of the market, and indeed how you can protect yourself given the volatility that investors are navigating at the moment. We also spoke about how Chinese government policies could impact commodity prices. Take a listen, it's a really interesting interview. Kerry, as an investor, sometimes when confronted with a complex picture, it's valuable to try and dissemble it and create a simpler picture as a starting point for better understanding. Is it possible to make a simple picture out of what we're presented with today?
Well, I think it is. Obviously, there's a huge amount of nuance and complexity to what we're seeing happening around the world, the behavior of markets. But there's a few things and pillars you can really look back on. And I think at these times of uncertainty and when there's lots of headlines coming out, you really want to fall back on, well, what am I actually trying to achieve with my investing? What's my objectives of my goal, and am I positioned to achieve that? And so at times like we have now, when there's been a big sell-off in the market, you're kind of thinking about, well, how much do I need to ensure my portfolio is protected against some of that risk, and do I have the right mix of assets, especially after you've had a couple of really strong years of equity performance. So a lot of the focus is about ensuring you have that balance in your portfolio, protecting against those shocks, and that's ultimately what's going to see you through to achieve those long-term gains in your portfolio and those objectives about wealth creation or income or whatever it may be. And I think more broadly, if we just take a look at the economy and think about what's really happening around the world, a lot of what you have is like a policy-induced shock. It's not something that was fundamentally wrong with any economies. I mean, we're coming out of that sort of period around COVID. Growth was looking pretty good, actually more resilient in the US than being expected. So it's not always a problem with economies. It's obviously a policy-induced issue, and that can go away pretty quickly.
Indeed, and I suppose ultimately the flow-on from this policy is that we're going to see lower rates at some stage. You're actually seeing energy prices fall. The outlook for growth expectations is beginning to get trimmed, but it's not falling off a cliff. Is that a reasonable construct to use as some big inputs?
Yeah, I think that's right. So those inflationary pressures have been coming down in many parts around the world, certainly here in Australia. We had policy easing already entrained by many big central banks around the world. So the RBA is cutting rates here as well. That was creating a pretty good environment from where we had been, and would support growth and consumption and help households continue to spend and drive that growth. But there's also a big change in terms of the fiscal side. So if you look around the world, what you're seeing is much more fiscal activism by governments. So what they're doing in Europe, what they're talking about doing in the US, or even what we hear here in Australia around support for cost of living and spending by governments. And so you do have those two big policy shifts in terms of easier policy and then a bit more on the fiscal side, and that can help lift growth as well. So that dynamic between what we saw a few years ago in terms of the fiscal and the monetary working against each other, now they're going to start working more in tandem.
That's significant, isn't it, when it comes to asset markets like equity markets, to see both of those arrows pointing in the right direction?
Absolutely. So, what is a market? It's a valuation weighing machine. They're just looking at the probabilities of what's going to happen, and if that probability is for a better growth outlook, or at least not a recession, then you're likely to see those markets react to that and continue to price in a better outlook. Now, that's a little bit troubling at the moment, given the level of uncertainty, and that's what people are really grappling with. But overall, if you think about the business cycle, the economic cycle, it's one where we're still seeing that extension to it. We're not really thinking about what would cause that to come to an end, and that does mean positive rates of growth, a little bit less inflation, and a little bit less growth than what we would have liked, but still positive growth.
Now, an important consideration when you have such a big shock, even though it's a policy-induced one, is second and third order consequences that perhaps might not have been estimated. Is there any risk in your thinking that there is some sort of a systemic problem that could be unveiled because of this volatility that we've seen?
Yeah, it's always the risk that there's something lurking under the surface, that there was something that wasn't really accounted for, or stress that was created by some sharp market moves. I mean, you see that a little bit with what we saw in the bond market in the US, these big 3-day moves in yields. A lot of that coming back down to, positioning across hedge funds and others and thinking about how they unwind as those stresses start to come through. But that's a big difference from saying there's something wrong with the financial plumbing. That's a big difference to saying that we need intervention to make sure that's happening, or provisions of liquidity by central bankers, for example. So those ones really haven't come through. And I think if you look at how household balance sheets have shaped up, or even corporate balance sheets, they're in a pretty rude health given what's happening in the economy. And that's actually quite a positive for saying how you could sort of weather some of these shocks as companies, have the ability to, protect margins, cover those costs, don't really have to think about firing people so much. And it does mean that you could see a slightly more milder outcome than perhaps what you would have assumed going through some of these shocks in the past.
Kerry, the world's biggest sovereign wealth fund is the one owned by the Norwegian government. Recently, they said that they still regard the US dollar as a safe haven. They still like US corporates, and they're enthusiastic about buying them. That's an important consideration at this point in time, isn't it?
Yeah, I mean, there's a big discussion around US exceptionalism. You had 2 years of amazing performance out of US equities, for example. A lot of that was justified. The economy was looking great. You had these big tech companies that were delivering huge profits. They had technology that others didn't, so creating a bit of a monopoly almost around that. And so it really did justify that to a certain extent. And there was, parts of the market that got pretty expensive on that basis. A lot of it's become a lot cheaper. And so it does bear worth watching, because these are still really high quality companies that do have that market pricing and market power that is there. So we shouldn't give up on that idea. I think the question now is around whether, there's options elsewhere around the world at better valuations. And some of these questions around how much of that political dynamic is going to be reflected in the market, rather than just thinking about corporate fundamentals. We would still certainly look towards the US and the quality that it represents in a portfolio in those companies and the ability to deliver those earnings. And the valuations have got a little bit better than they had been in the past. The question really now is, again, have we gone through enough of this pain to justify that? And that's where I think us and many in the market are still waiting for that to come through. So I think a period of patience, but keeping an eye on those opportunities is really how we would approach it in the portfolio.
I mean, if you're still asking yourself those sorts of questions, an important part of your thinking should turn around creating resilience in your portfolio. How do you do that?
It's a great question, and I think it's one that's been asked for a number of years now. So go back to 2022, for many investors, this idea of we have equities because they deliver that growth in our portfolio. We have bonds for generating income, and also diversification benefit because they should offset the equities if there is a fall, and vice versa. Didn't hold up, right? So you went through this weird period where both equity fell and bonds fell, and it didn't really deliver on what it should do. A lot of that was driven because those correlations between those assets didn't hold up as historically they would. And that's kind of what's echoing in the market at the moment. Questions now being asked around, if we get a lot more inflation, does that negatively impact that price of bonds? And we go through that same pain period. For us, it just reinforces that case that, if there is a recession, fixed income still diversifies your portfolio. It still acts as that buffer because yields are high and they can fall a long way from here. However, to ensure you have that insulation in your portfolio, there's a range of other asset classes that aren't correlated to the economy or correlated to equities, which can offer that diversification and offer income. We think about real assets such as infrastructure or transport or even real estate to a degree. All these things can build in that additional layer of diversification of portfolio and give investors a bit more confidence they have ballast against the risks that they want to hold if they do see those opportunities arising.
Within that, there's also, I suppose, this sweet spot or moment in time where you actually have both of those assets moving in the right direction. We seem to be on the foothills of something like that at the moment, where there's been a pretty substantial rally in bonds. We've seen a correction rally in equity markets. How do you put that into context?
I think it's more of a passing the peak, right? So we had these big announcements that came out. Everyone got very worried. The market sold off. And then suddenly some of these announcements are being dialed back a little bit. There's been a reevaluation about how bad things could get. But again, it's not absolutely clear. It's hard to get away from being dragged into the micro from those headlines that come out all the time. But I think it's important to, take a step back and rather than looking through a microscope, look through a telescope and say, what's the bigger picture here? The bigger picture is that you're going to have this bubbling uncertainty for a while around the policies and the policy dynamic in the US, and that could still be reflected in the market. So, we think having an eye on risk assets at these valuations is appropriate, but we want to have a pretty balanced view between owning risk and growth assets and owning those defensive ones at the moment, given those shocks could come through. And we could see a recession in the US start to bubble through, and we could see, that have a broader impact on the global economy. So I think there will be a point in time where you want to shift back towards risk and adding that to the portfolio. But for now, I think it is about ensuring you have the ability to weather any more shocks that do come through.
It's a difficult position for a market like the Australian market because of our pointing towards China, our exposure to the broader volatility piece. But then, when you look under the bonnet in terms of what the Australian market gives you, it's a pretty narrow aperture. How do you approach investing in the Australian market under these circumstances?
Well, I think it's, again, somewhat defensive because it's high income, and income is defensive when we think about what it does to returns, and that's some of the appeal, and I think adding to the performance you've seen most recently. It's also, on the first order basis, it's a bit removed from what we've heard around this whole trade. The impact of tariffs wasn't so high. And again, it's rightly sort of geared towards the Asian region and China, particularly for its growth. And there, we're seeing more news out of China about what it's doing to support the economy. And as it does more to support growth, naturally that reflects well on markets around the region and particularly in Australia, if it does create more demand for commodities and hold up prices. So I think that is being helpful. And also, that starting point, we were coming from last year, we had 1% growth for the economy. You're thinking about the drags of higher inflation, tighter policy rates. That's all starting to go away. You've got inflation coming down, you've got policy rates coming down, you've got subsidies from the government for cost of living. Household incomes are actually rising in real terms. And so that consumption boost is helping here as well. So on a growth basis, Australia is looking a little bit better than some parts of the rest of the world. That disinflationary dynamic is helping that policy easing. I think that's been reflected in the market here as well, relative to what you've seen outside of the world. But as you mentioned, Australia is 2% of global equity market. It's a very small pool. I think if you're generally building a portfolio and wanting allocations to growth assets, there's great companies globally, and you shouldn't look much broader than just Australia for that.
Kerry, we spoke about second and third order consequences that might not be estimated. And given the fact that the Trump administration has been quite pointed in their focus on China, is there something here that we should be looking at in terms of a fault line in the Chinese picture that could rear its head and make things a little more uncomfortable?
Yeah, I think there's a couple of dynamics there around where the leverage and where it lies in terms of the economy. The first is that the US economy, starting from a relatively good position of strength, has momentum. You haven't seen the data that really suggests you've got a big drawdown in the economy just yet, but for many market watchers and economists, they're kind of waiting for it to happen. It's just a matter of time. Whereas the Chinese economy, trying to delever, had a big housing problem with the property market, has deflation in the economy, unemployment was relatively high. It was trying to get itself back on its feet. So a very different starting point for China. So that would sort of err in China's or the US's favor, and China might be feeling more pressure to want to do something to negotiate, want to be able to get the economy growing. The flip side of that is China's a very patient economy. They can wait to the US starts to feel that pain before they enter those negotiations. And so I guess the issue there is that neither side is really going to be that willing to come to the table. And if that doesn't happen, you just see that escalation come through other ways. So whether it's on the security front, whether it's on other capital controls that get in place, and if that relationship becomes more strained, then that will get reflected in how investors see risk appetite around the world. And that really is the risk, that you just don't get to that negotiations that's so badly needed relative to what we're seeing in the rest of the world.
You mentioned that this is an environment where patience is going to be rewarded. Is there one thing in particular that you're looking towards, that when you see that emerge, then your comfort level starts to improve significantly?
I think so. There's two ways I'd frame that. The first is that markets have been very volatile on either fixed income or equities, and that volatility, if you look at it on a short-term basis, does look dramatic. Again, if you look at volatility over a longer-term basis, it goes away. So time and diversification are your best friends for tackling volatility in your portfolio, tends to subside. The second way I'd probably think about it in terms of looking for that clarity around what's happening is, stabilization in the economy in terms of going through that downshift and a lot of those economic indicators, starting to see them balance. And I think that's when you start to have more confidence that you're through the worst of it. And then the markets will start to think about, this being behind us rather than ahead of us, and thinking about the uplift in earnings and how to take advantage of that.
Kerry, great insights. Thanks for your time.
Thank you.
And thanks very much for joining us for the Executive Series.